Welcome everybody to Commerce Ki Pathshala. I'm CA Rakhshan and today we are going to discuss certain concepts about accounts. So let's get started. Starting up with the differences and similarities between bookkeeping and accounting. A lot of times we see bookkeeping and accounting being used interchangeably. But are they similar or are they different? Let's try and understand that. So we begin with the definitions. Definition of bookkeeping. It says the activity or occupation of keeping records of the financial affairs of a business. Example, records keeping by Munimji. Accountancy. The definition goes, the profession or duties of an accountant or accounting, the process or work of keeping financial accounts. Example, accounts maintained by a chartered accountant. So with this, we understand that bookkeeping and accountancy are fundamentally one and the same thing. But what makes them different? So let's take an example to understand the difference. The kirane wala next to your house, from whom you purchase groceries, would definitely keep a record of the stock he has in hand, the cash he generated during the day, the profit he made during a month. But for all of that, he would not necessarily need a balance sheet, a trading or a profit and loss account, or complicated accounting norms. For him, the basic records of inflow and outflow, stock addition and depletion would be sufficient to let him arrive at a profit. Whereas, considering a business entity like TCS, a TCS would not necessarily stop at only knowing the stocks, cash generated and the profit made. They would definitely need something more. Like assets that they have needs to be depreciated. The intangibles that they have needs to be amortized. The preliminary expenses. So accounting is a more complex version of bookkeeping, where bookkeeping is okay for a small business entities, accountancy generally is followed at medium and large level. Let's take a step forward. We'll understand the differences between the two with 4 pointers. The first one, bookkeeping and accounting are different from each other. Bookkeeping is an important part of accounting. Well, the first point justifies our understanding before, where we said bookkeeping and accountancy are fundamentally the same thing. Second point, it says the bookkeeping is the base of accounting. Accounting starts where bookkeeping ends and thus is the broadest in scope than bookkeeping. Well, absolutely. Accounting is the next version of the bookkeeping, if I put it that way. Anybody would have to know the fundamentals of bookkeeping, the fundamentals of inflows and outflows, debit and credit, for them to understand the next version of bookkeeping, that is fundamentals of accounting. The third point says financial statements do not form a part of bookkeeping. Thus, these are prepared from accounting processes. Well, yes, Munimji would not need financial statements for his setup, whereas TCS would definitely need financial statements at year end. But am I saying that chartered accountants doing financials for TCS need not have the basic understanding of debit credit? No. So although they don't need, the bookkeeping is not restricted to the financial statements. The financial statements are derived from the accountancy and accountancy is yet derived from bookkeeping. So the last part says the accounting reports help in ascertaining the financial position of an entity. However, not bookkeeping records. As we discussed earlier in the example, financial statements or the financial position deciding about the entity, the assets needs to be depreciated, the goodwills need to be amortized, there has to be additions, there has to be debtors, creditors and all of that, which says about the financial position of an entity. However, the kirane wala would not need all of that. So you don't really arrive at the financial position by the records kept by the kirane wala, but you definitely arrive at the financial positions by the accounting norms followed by a CA for a big company. Having said this, let us go and understand process of accountancy a bit more in detail. So the process of accounting flows in the following 6 steps. The first one, it says identifying the financial transactions, followed by recording of financial transactions, preparing ledger accounts, preparing trial balances, preparation of financial statements, and analysis of financial statements. What does this mean? We'll elaborate with an example. Say an entity like TCS is purchasing an asset. So how will the asset be accounted in the books of accounts, or how will the asset be determined in the balance sheet, and will in turn talk about the financial position of an entity. So the process of accounting, identifying the financial transaction. So here transaction will be the asset purchased, where there will be cash being given out and the asset will be coming into the entity. That is a transaction that the entity does, asset purchase. Recording of financial transactions. Now this debit and credit of asset and cash will be recorded as a journal entry based on the invoice of the asset, based on the other documents under which the asset has been purchased. And likewise, the asset account will be debited and the bank account will be credited. And which comes to the third step, where we say preparing ledger accounts. So here 2 ledger accounts will definitely be affected, which is the asset account and the bank account. Once all these ledger accounts are prepared, what we do is we prepare a trial balance at the year end. While in certain entities the trial balance happens simultaneously in the software, we understand this process in a more old school manner, where we say the preparation of the trial balance happens at the year end. With that trial balance, what we do is we prepare financial statements, and one of those statements will be the balance sheet. And with that balance sheet, when we study that balance sheet, we say we analyze the financial statements, and likewise, while studying the balance sheet, we will know the financial position of an entity. So that's how the accountancy process goes. That's how the accounting of an asset will take place, and eventually the financial position of an entity will be evaluated. Here I have given the cycle of accounting, which begins with journal entry. Of course, the journal entry also has a history of the financial transaction taking place and the supportings and the vouchers coming in. Journal entry followed by preparation of ledger accounts. Then what we make is the unadjusted trial balance. Unadjusted, why? Because at the year end we'll pass the adjusting entries of depreciation, and then you will get the adjusted trial balance, with which you prepare financial statements. Financial statement includes profit and loss, statements of profit and loss, cash flow statements, balance sheet, notes to accounts, etc. Going forward, you have closing entries that you need to pass, and then finally you post the closing entries into the trial balance, and the cycle continues. I hope this lecture was well understood, well absorbed by the students. Any kind of doubts, please leave them in the comments below. We will be happy to solve. Thank you very much. Goodbye.